Hello and welcome to the lecture for the first part of Chapter 18. So today's lecture will be primarily about definitions, about terms that we're going to use in the rest of the quarter, kind of what those words mean, and I'll explain a little bit more about that as we go. What I would recommend is reading the entire chapter, listening to the first part lecture that I'll post that you'll find obviously in Canvas, doing the first homework problem, which is due on Wednesday, the 15th, and then watch the second lecture for Chapter 18 and then do the following homework. So that'd be kind of a good pattern to work through all of these chapters. And as I mentioned before, I'll try to keep these lectures to about 15 to 20 minutes at the most, so pretty doable. So this chapter covers kind of a broad overview of managerial accounting, talks about operations, costs, and terminology. The second lecture will talk more about financial statements for a manufacturing business, and then uses of managerial accounting, kind of what it's good for. So the key uses of managerial accounting information, as I mentioned a little bit in the intro lecture to the course, is one, I need to know what the cost of all of my products are. Now, if I'm making a physical product, I need to, of course, know what that product cost. If I'm providing a service, say I'm running a medical care facility and I'm doing MRIs on patients, I need to know what it costs to give somebody an MRI. So whether it's a service or a product, I still need to know the cost. The reason I need to know the cost is that might inform how much I sell the product for. If I want to earn a certain margin, if the cost is $50, I might want to sell it for $100, so I have a 50% gross margin. If I'm doing financial statements, I need to know what my cost of goods sold is, and I need to know what my inventory value is, so I need to know product costs for that reason. I might need it if I want to beat the competition. If my competition is selling for a slightly lower price than me and I want to know if I can match or beat their price and still make money, I need to have a really good idea what my costs are in order to do that intelligently. In some companies, you need to know what your costs are if you're preparing bids. For example, if you're bidding on building a new building for the college, you'd need to know what your costs are. And then analyzing profitability. In almost every company, different products produce different levels of profit. Some products produce a lot of profit and some products can actually have negative profitability. You can lose money each time you're selling them. So being able to analyze that to make intelligent decisions about what do you sell and what don't you sell is key. Planning and control. That's about budgeting, and we'll talk about that in the latter half of this course. Every single line item on a financial statement should have somebody's initials next to it. There should be somebody responsible for everything. If there's a line item or a cost that's being incurred that nobody's responsible for, I guarantee you the spending will be out of control. We want to be able to measure how we're doing periodically and compare it to that budget to say, are we on track or not on track? And then take necessary corrective action, either cut expenses or whatever the case may be. I mentioned before two different types of accounting. So 201 and 202, you've talked about financial accounting, learned about that. Its focus is on external users. Company management also uses it, but primarily external users. And everything is done according to generally accepted accounting principles, or GAAP. You generally report on the whole company, okay? Management reports, so managerial accounting, that's just for internal purposes. It's so that people running the company can make good decisions about what to do going forward. In that case, it's not based on certain standards. It's based on what do you need to be able to intelligently answer the questions that are being asked. So it's based on what management's needs are. You could look at the company as a whole, but it also provides greater insight in the sense that you can look at just portions of the company, product lines, divisions, geographic areas, things like that. So a little bit about company structure. There are two different categories, staff versus line. So staff is people that support line functions. So purchasing or HR is a better example. Human resources, hiring and firing people, is a staff function that supports line functions which actually do the company's business, make the products, that sort of thing. Accountants are staff positions that support the production of the company. So the management process in general deals with strategic planning. That's kind of a higher level. Where do we want to go as a company? What kind of businesses do we want to be in? How do we want to be positioned in our marketplace? Do we want to expand internationally, as an example? We've been making, say as an example, we've been in the lawnmower business and we want to expand into weed eaters and edge trimmers or something like that. Those would be strategic decisions. That then boils down to operational planning. So every big picture strategic decision should result in operational decisions, meaning who does what when. How do you spend money in order to execute those larger strategic decisions? So that involves directing the activities of other people, telling them to do different activities and spend different money in order to accomplish that. Controlling means checking, are we on the path we intended to be? And if not, let's bring ourselves back. It could be about improving functions. There's no company that's perfect that does everything right. There should always be improvements. And then lastly, decision making, which is kind of inherent in all of the others. One key thing about managerial accounting that I'll come back to over and over again is management by exception. What that means is there is too much going on in even a small company for the person running it to pay attention to every single detail. So they need a system where the issues that they need to focus on, the problems, are brought to their attention so they can focus their efforts on what might be 5% of the details, not 100% of the details. So on to some definitions. So cost versus cost object. So cost is a payment of cash or a commitment to pay cash in the future if you buy something on credit that's for the purpose of generating revenues. So that cost might be buying raw material in order to produce product that you'll sell in the future. It might be hiring laborers that will convert that product, that raw material, into your product for sale in the future. It might be advertising that you spend now so that you can generate customers in the future. Those are all costs that are incurred. Cost object is just a way that we might want to frame something to look at it in a certain way. So it might be a product. If my cost object is a product, then I'm going to analyze cost relative to that product. What went into making that product? If my cost object is a sales territory, then I would look at what are all the costs that are incurred for that geographic area where I have a salesperson. So I'm going to kind of frame how I look at costs in a different way. And we'll come back to that over the course of the quarter. So here's some more terminology. So a direct cost is a cost that can be identified and traced directly to a particular cost object. So the easiest way to think of this is a physical product. And an example I'll use throughout the quarter, because we all know what it is a company that makes picnic tables. So wooden picnic tables. So a direct cost in a wooden picnic table would be all of the cost I can directly see in that table. So the lumber, the brackets, the bolts and nuts that hold it together, all of the components that I can physically see with my eyes that went into that particular product are direct cost. The people that put their hands on it and cut the boards and sanded them and bolted it together, those are direct cost. I can directly tie the cost to that particular object. An indirect cost are all the costs that are incurred but I can't necessarily point to that particular product. So as an example, when I'm making wooden picnic tables, I need to sand them, okay? And I consume sandpaper. I go through 10 boxes of sandpaper a month, so I'm using up sandpaper. but I can't point to that table and say how much sandpaper was used in making that table. That could be really difficult to determine. So that would be an indirect cost. The heating and lighting for my factory. I can't make picnic tables in the dark without any electricity. So I had to have electricity in my factory in order to make those picnic tables. But I don't know how much electricity goes into each table. So those are all indirect costs that were necessary to make the product, but I can't directly trace them to the product. So different categories of manufacturing costs, we'll come to this over and over again in the quarter. This is really a fundamental concept. So direct materials, those are the materials that you purchase and directly go into the product. So in the case of our picnic table, it might be 2x6 lumber and 2x4 lumbers and brackets and nuts and bolts. The next category is direct labor. Those are people that are putting their hands on the product and physically transforming it in some way. So somebody standing in a drill press, drilling holes in boards to make my picnic tables would be an example of direct labor. The supervisor that's watching over him that is involved in the production but not touching the product and altering it would be an example of factory overhead. So factory overhead are all the indirect costs associated with making this product that I can't directly trace. So the rent on my factory, the electricity in the factory, the depreciation on the machinery in the factory, supervisors, quality control inspectors are all examples of factory overhead. There's a key formula. The total cost of any particular object is going to be equal to the direct material plus the direct labor plus an allocation of factory overhead. That will represent my total cost for a product. The next definition I want to talk about is product cost versus period cost. So product costs are, as you can see here, direct material, direct labor, and overhead, like I talked about on the past slide. So the key thing to think about this as costs flow through a business is product costs are going to attach themselves to the product, and they're going to stay with the product until the product is sold. So if I have a picnic table factory and we make picnic tables all month long, we make 100 picnic tables, we don't sell any of them. All of the cost that I incurred to create those picnic tables, all the lumber, all the direct labor, all the factory overhead, is going to be sitting in my inventory, because those costs are attached to the inventory, attached to the product, and the product is in inventory, so those costs are going to be on my balance sheet. I will have no cost of goods sold that month because I didn't sell any picnic tables. So the costs are trapped in inventory until I put them on the back of a customer's truck and sell them. Then they transfer out of the balance sheet, the inventory account, into cost of goods sold on the income statement. So the costs are attached to the product and they follow the product. As opposed to product cost, the other category is period cost. Those are costs that are not directly associated with a product and they're expensed as incurred. Advertising expense, the president's salary, the insurance for the company's cars for the executives, the receptionist salary, the accountant's salary. All of those costs are not attached to a product, they're expensed as incurred. Oh, one further point on that back slide. Prime cost is direct material and direct labor. Conversion cost is direct labor and overhead. So the last slide I'll cover in this part of the lecture is just some more details of product versus period cost. So in the example on the top there, product cost would be the wood. This is a guitar factory. So wood used in the neck and body of the guitar. Direct labor cost would be the saw operator and the assembly people. And then factory overhead would be guitar strings, wages of the janitor, all of those other things about the factory. Now, one thing you might be asking, guitar strings. I could definitely see guitar strings in the guitar. I could trace the guitar strings to that guitar and I could record the cost of those strings. So it's a little bit squishy. And if I were doing it, I would include guitar strings in the direct material cost probably. It works out to a cost benefit equation. So I could trace every single cost and call them direct material costs, but it would involve an awful lot of work. And you have to look at the benefit you get from that improved information versus the time it takes you to allocate those costs to individual products. So there'll be some items like that, small cost items, where, as an example, staples in a magazine. Some people would include the cost of the staple as direct material. Some people would include it in factory overhead. You're going to get to the same place either way. It's just a matter of how much work is involved. And then period costs, we have advertising, salespeople, commissions. Those are selling expenses. You'll remember that from Accounting 201. And then administrative expenses like office salaries, office supplies, things like that, which are incurred, are expensed as incurred. So that's the end of the first lecture. The next lecture will pick up on financial statements and the flow of costs through T accounts. So I look forward to talking to you then. Bye-bye.